Hi, I'm Ben, partner at InnoVen Capital Southeast Asia. Today, we'll be talking about investing in venture debt. Venture debt is a type of loan financing provided to venture-backed companies predicated on the company's performance, amount of equity capital a company has raised, and the quality of the company's venture capital investors. These companies frequently can't obtain loans from traditional banks as they do not fit traditional lending criteria and typically only rely on equity to grow. Hence, venture debt is an attractive option to any startup founder seeking additional growth capital that is less dilutive in nature and is generally a cheaper source of capital. Companies can use it for financing solutions for working capital or simply to extend their cash runway to give them more time to achieve better milestones. Investors in a venture debt fund take on the credit risk of the underlying portfolio of companies that the venture debt fund lends to. These companies are usually high growth but cash burning startups which are asset light and may present various default risks. However, with tight credit structuring and proper due diligence and good screening criteria, a venture debt fund can possibly mitigate these risks. Although the target company may be similar, the risk-reward profile is different. For venture debt, the underlying investments are mainly tightly structured loans that are repaid within 1 to 3 years. This enables investors in venture debt to start receiving cash distributions much earlier and will allow them to recover their initial investment amount much faster as cash from the loan repayments can be distributed back to them. However, returns will be lower as the bulk of the return comes mainly from a fixed interest rate charged. For venture capital, the underlying investment is equity in high-growth companies. While this may take longer to monetize, the returns can be higher as equity returns can be extremely high if the investee company becomes very successful. This means that venture capital investors would likely receive cash distributions much later, though the total returns are higher. The current market climate is one of increasing interest rates and economic uncertainty. This has led to a sell-off in public markets and decreasing equity valuations. In turn, this has led to decreasing equity valuations of venture-backed companies as equity investors frequently benchmark their investments against the public comparable. And all in all, this has led to a perceived slowdown in venture capital investing as these investors may not be able to achieve their target valuations. As venture debt targets the companies that have raised venture capital, the slowdown in venture capital may lead to a slowdown in venture debt. Although Southeast Asia is not entirely immune to the global macroeconomic situation, we do not see a slowdown in the venture capital market here as there are many new funds being raised. We see that the new funds being raised will target startups at earlier stages and investors hope to fund across the company's funding life cycle. For example, investors may now invest in a company's seed, pre-A and Series A rounds rather than making a larger one-time investment in its Series B. Necessarily, we as venture debt lenders will also refocus our efforts to lend together with these investors at earlier stages.